Hey there, I am John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today, let's answer the question on whether or not annuities are better than a bond ladder strategy. So it's not really a either or, it's just which one works better for you. They both are good. In my opinion, if you're looking for something that is low maintenance and gives you high income over your lifetime, then I favor annuities for that reason. But bonds are great too, because bonds you can liquidate. That they offer a lot more liquidity. So if you want to get out without having any type of surrender charges, then you can do that with a bond ladder. The problem with that, of course, is you have to continue to each time it matures, you have to continue to roll it over into another bond, and you have to manage that, and you have to continue to make sure that your spouse, if you're married, can do that as well. And so over time, especially as people's ability to think and to reason declines, then a lot of times an annuity contract can be a lot more simple. And really, once you set it up, you don't have to worry about it anymore because it just keeps dropping in your bank account. So I'll illustrate these to you, and you can kind of decide for yourself. I have people that will reach out to me and they'll buy MYGAs as their bond strategy because they like the guarantees that they provide. The rates are great, and they love buying them, and they'll roll them over to another MYGA as soon as it matures. And they'll ladder them out. They might buy a 5, a 7, and a 10 year, and then just have different maturity dates. And they like doing that, and they like holding on to their principal. So if that's you and you're thinking, I want to hold on to my principal, I want to have I don't want to lose any of my principal, I want to leave it for my heirs, then that might be the best strategy for you. Either do a bond strategy or do a MYGA strategy, which is very similar, but a lot of times you can get better rates. So if you want to look at rates right now, go to my website, johnstevenson.com, and you'll be able to take a look for yourself what MYGAs are paying. And MYGAs just stand for multi-year guaranteed annuity. It's the same as a fixed annuity, a fixed rate, and very similar to a CD. And so you can look at rates there. If you want to look at income, then look at the income rider or the SPIA and DIA contract. So let me share my screen though and kind of illustrate this for you, because a lot of times there are arguments that annuities are better because they're cheaper. Meaning if you live a long time, the income that you can get from them, dollar for dollar, sometimes they can be a cheaper, less expensive option than maybe doing a bond laddering strategy. So everyone has their different opinions. I just like the simplicity. Okay. I like to be able to set things up, have a high rate of income that can never decrease, and that is contractual, and something that I don't have to manage. I can set it up to go to my bank account, and then if I die, my wife continues to get it, and I just don't have to worry about it, and neither does she. She doesn't have to worry about worrying about different bond strategies and making sure that she is making sure that they're rolled over at different times when they mature, and not forgetting to do that. I mean, that just takes effort, and a lot of times when you're retired, you don't want to do that. Okay, you get kind of tired of that, and so maybe this will help. When I share my screen, I'm just going to go through some of these scenarios. And then, of course, if you want to use my annuity calculators on my website, go ahead and do that as well. If you are looking for an annuity and you're thinking, I would like to purchase an annuity with someone who is transparent, I'd love to help. There is a link below this video. It goes directly to my calendar, and we'll get on a Zoom meeting, and I'll show you everything that's available. You can also do that on my website, johnstevenson.com. There is a link to book with me there as well. But let's dive in, let's take a look, and hopefully this will at least give you some clarity and some value as you continue to decide what you're going to do for your retirement. Okay, so let's take a look at, I'm going to just change a few things here. Let's say Louisiana. Okay, and I'll just say 500,000. Your amount might be a lot more, might be a lot less. It doesn't matter. This will kind of give you an idea. And of course, this is why I tell people use my calculators, because your ages and whether it's a single payout or a joint payout, of course, is very personalized to you. So looking at this, if I was to take income, and let's say I want to take income a little bit earlier, I just say 64. Okay, so I'm going to put 500 grand in at 62. I'm going to take it at 64, and I want it to be joint. So looking at that, and this is probably the simplest way to do it, and then I'll show you some MYGAs. So if you want to do like a ladder strategy that way, you can do that as well. All right, so looking at the companies, let's see, Corebridge, F&G, ClearSpring. Yeah, they are definitely the top payouts for deferred. Prudential is pretty good for immediate, but they're not as high for deferred. So it just depends on what your strategy is and how long you want to defer taking income. But that's not bad. So $40,000 a year, guaranteed for the rest of your life and your spouse's life. Now, if you were married, let's say you're just a single male and you're like, I want highest income for myself, okay, and that's in 2 years, then it's a little bit higher. So that's nice to have as well. So, but you just got to realize that once you pass away, the income stops, and then whatever is in the account balance will go to your beneficiaries. So they won't get income, but they will get whatever's left in that account balance. Okay. So, all right. So I'm going to go back to joint, and I'm going to now take this. All right. We got, what do we got? 40,000 a year. All right. Now what if I did immediate payout, taking it next month? Yeah, see the difference? It's $33,825. Prudential, of course, is the highest right now, at least as of the recording of this video. They are the highest for an immediate joint payout. So pretty good. For a single payout, let's see what that would be. Yeah, a little bit more. So, and it's just because they have withdrawal rates that are a little bit lower when it's joint versus a single payout. The withdrawal rates are a little bit higher. And so, and the income's guaranteed for life. Like if you look at this, if I was to take immediate income based off of this, just for myself, then you can see that income coming out. So I'm taking out what, $3,000 a month roughly. And that comes out for the rest of my life. It's very nice. It's not a bond laddering strategy. I don't have to roll this over. I'm literally locking in a rate and I just don't have to think about it anymore. Okay, that's really nice. And I did it with 500,000. So I put that in. The 500,000 eventually will be gone. By the time I'm in my mid 70s, it's all gone. Okay, but I didn't do it for legacy. I did it for income, and that's why people do it. They set themselves up for that. And maybe I got Social Security that's coming in that's paying me $30,000 a year. Maybe I got a small pension that's paying me $15,000 a year. That's pretty nice. I've got this stacked on top of my Social Security, stacked on top of my other pension. And then maybe I've got my other assets still sitting in the stock market. And so I can let those continue to compound and grow, which is great because if I've got my annuity income covering me right now, and I've got my Social Security and I've got, maybe my small pension that's working out for me. And I'm like, all right, this is great. I've got maybe only another $400,000 left to invest, then I'm going to feel more comfortable just leaving that in the stock market. So I'll show you what I mean. Like I can go in here and say, well, so if I go in to, let's see my calculator here, and I pull up, let's say 400,000 after 10 years. And let's say I just put in the S&P 500 because that's where I have my money right now. Okay. S&P 500. And I don't add to it. I just let it grow. Okay. Ending balance is $1 million, $1,037,000. Okay. All right. After that, I might think at the end of 10 years, well, I'm already getting, close to $80,000 a year with this annuity I just bought, with my Social Security, with my pension, but I would like to increase it because inflation, right? So at the end of 10 years, I've got $1 million. I'm going to sell some of my positions and I'm going to, it'll go down to 750. Okay. So I'm going to pay another $250,000 for another annuity contract, add another 20 or 30 grand a year in income. Okay. Because I'm older. And because I'm older, I don't need as much, right? So now I've got more income coming in, and now my 750, right, because I didn't take it all out, continues to grow in the market. Now another 10 years goes by, and it's now worth almost $2 million. Now at that point, maybe I need long-term care, or maybe I don't. Maybe I'm going into assisted living, or maybe I just want some extra money because I want to pay for more things for my grandkids or higher health expenses with the doctors I want to choose. I might take half of that and say, all right, well, I'm going to take half of this now and generate another $100,000 a year in income. Okay. And that's the beauty of doing this is you can just set it and forget it and you can just stack your income. So not saying this is the only way to do it. You could absolutely do a bond strategy and do fine. It's less work to do the annuities because you can just set up your contracts. You can activate your income and that's it. Okay, the money keeps coming in and it keeps dropping in your bank account. And then if you want to invest in the other stock market investments, you can do that. Okay, you kind of get the best of both worlds. You get the guarantees, but you also get your market-based investment growth if you want. All right, so let me go back to the MYGA calculator because I mentioned those. I'll say top MYGAs. So MYGAs, again, they're the annuities world version of a CD. Okay, usually they pay higher rates. And they have state insurance that usually covers them up to $250. Some states are higher. So when you look at this, you say, all right, well, here's the top options. Let me just go in here. Say any funding. We'll say any rating, top MYGAs, And I'm going to load a little bit more here so you can see all the options here, because you might want to buy a 5-year, maybe a 5-year at a 6.3, right? This one doesn't allow taking any interest, so maybe you want one that does. So they got an option that allows 10% after the first year. It's a 6.15, so it's not too big of a hit. So I was like, all right, well, I'm going to pay for, let's say I'm going to buy 3 of these at $200,000 a piece. Okay, $200,000 a piece. And I want to do a 5 and a 7 and a 10. I'm just saying, if you want the highest rates, that's where you find them. Okay, the 5, 7, and 10-year MYGA options. All right, so for this, so this ending value, well, the total earnings is $69,000, so it'll be $269,000. 5 years, and then the 7 years. Grab one of these. Let's say I do Revel 1. Then it'll be $297,000 for that one. Okay, and then the end of 10 years. Then let's say I did farmers and I've got 151 grand in earnings. So what, 351? Let's see how that grows. Yeah, there you go. So you put $200,000 in, you can see the growth, you can see the compounding over time, obviously higher compounding earnings, resulting in a net 351 that you're going to take out at the end of that term. So, and that's what you can do. And I have people that'll set these up and they'll use them for legacy and they'll just keep rolling them over, and that's fine. And they'll use them for income too. You can do that and withdraw, and then at different maturity dates, you can roll them over into something else. It's more work. It's more maintenance. And some people are fine with that. But as we get older, a lot of times we don't want to deal with that anymore. And we want to lock in highest lifetime income using income riders. So it's up to you. I really don't think there's anything wrong with either of these options. You just have to decide what you want the most for your retirement. Do you want something that's just that's more liquidity but more maintenance, or you want something that's less liquid to you as far as an annuity contract, but gives you much higher lifetime income? So it just depends on what you're looking for, whether you want to maintain something, and spend the time for it or not. So anyways, hope that helps. If you're looking to purchase an annuity, I'd love to help you. There is a link below this video. It goes directly to my calendar, and we'll get on a Zoom meeting, and I'll show you everything that's available. So otherwise, go to my site, johnstevenson.com, and research the annuities there. And if you want to book a call there, you can do that as well. So I'm happy to help. I don't bite. I don't try to sell you hard. I show you here's what's available. Here's what I recommend. And then of course, if you're looking to purchase, I'd love to help you. So anyways, if you like the video, make sure you like, subscribe, share, and watch all my other videos. There's so much good content that I like to produce, and it really helps answer a lot of questions. So I really hope that you enjoyed the video. And if you got questions, comment below. I'll answer your questions as well. And we'll see you next time.